Let's get right to it. Today, we're adopting a boardroom mentality to completely demystify the real story hidden behind corporate numbers. Far too often, people look at financial statements and just see a giant wall of math. It can be overwhelming. But as we're going to see today, those numbers are actually speaking to us. They're telling a super detailed story about a company's past, its current health, and honestly, its odds of future survival. So let's dive into this explainer and learn exactly how to translate raw data into powerful executive insights.
So, imagine this. What if I told you a company made a cool 1 million ringgit in profit this year? Your first instinct is probably to pop the champagne, right? I mean, a million's a great number. But what if I followed that up by saying, to make that 1 million ringgit, the company had to generate total sales of 500 million? Suddenly, that massive profit looks like a tiny, extremely fragile sliver. Actually, scratch that. It's a massive red flag. It points to terrible margins and bloated costs. The point here is, numbers literally only mean something when we know the full story.
Okay, here is our roadmap for today's briefing. First, we'll uncover the story behind the numbers. Second, we'll quickly review the 4 main financial statements you need to know. Third, we'll look at the 3 basic analysis techniques. Fourth, we'll analyze health through ratios. And finally, we will arrive at our golden rule, why interpretation beats calculation every single time.
Section 1. The story behind the numbers.
As financial detectives, we don't just passively read statements, we interrogate them. We look for the motives, the hidden risks, and the true performance metrics. Think of financial analysis kind of like a highly dynamic dashboard in the cockpit of a jet. It helps us answer absolutely critical questions. Are we actually profitable? Do we have enough cash to pay our short-term debts? Are our assets being used efficiently, or are they literally just sitting there gathering dust? It shows us the current health and the impending risk profile of the entire organization. Because let's be real, hoping for the best, that is not a financial strategy.
Moving right along, Section 2. 4 main financial statements.
These 4 statements aren't isolated. They work together as a complete ecosystem. First, the statement of financial position, or the balance sheet, shows you exactly what the company owns and what it owes at a very specific moment in time. Second, the profit or loss statement tells you how well the company operated over a period. Did revenues actually beat expenses? Third, we have cash flows. Now listen closely to this one. A highly profitable company on paper can still go totally bankrupt. It's true. Fast-growing tech startups learn this the hard way all the time. If you don't have the actual cash flowing in to pay your bills, you're done. And finally, the notes to the financial statements. This is the fine print. It's where the real context lives, detailing accounting policies, hidden commitments, and risks that the main numbers don't explicitly show you.
On to Section 3. 3 basic analysis techniques.
So now that we know where the numbers live, how do we extract real meaning from them? Well, we start with a couple of powerful techniques. Horizontal analysis is basically a time machine. You're comparing items across multiple years. Are sales trending up? Are costs growing faster than revenue? It's all about that trend line over time. Vertical analysis, on the flip side, looks at everything as a percentage of a base figure, like viewing every single expense as a percentage of total sales. This normalizes the data. It's brilliant because it allows us to compare the internal structure of a $1 million company right alongside a $1 billion company, perfectly apples to apples.
That brings us to Section 4. Analyzing health through ratios. We've looked at trends and structures, but ratios are kind of magic. This is the 3rd major analysis technique. They take 2 seemingly unrelated numbers and connect them to create a highly meaningful metric. To keep things super organized, we compartmentalize ratio analysis into 4 main pillars. Liquidity measures immediate survival. Simply put, can you pay the bills due next month? Profitability measures your actual ability to generate a return. Efficiency checks if management is using assets effectively or if inventory is just piled up in a warehouse. And finally, solvency. This assesses your long-term structural risk and your overall debt load. By checking these 4 pillars, executives can see the entire risk spectrum of the company at a single glance.
In our final stop, Section 5, Interpretation beats calculation.
Here is the ultimate executive secret. Absolutely anyone with a smartphone calculator can figure out a ratio. But true leaders, they interpret them. Let's say we've calculated a 10% net profit margin for our company. It means for every $1 of sales, we keep 10 cents. I want you to pause for a second and ask yourself, what does this number actually mean in isolation? Is 10% a cause for a massive company-wide bonus, or is it a reason to fire the management team? Think about it. The reality is, by itself, it means absolutely nothing.
But watch what happens when we add context. Let's say last year we were at 15%. Okay, so our performance is actively dropping. The industry average right now is 8%, so we're slightly above average. But look at our main competitor. They are sitting at a 20% margin. Suddenly, the harsh reality sets in. Our 10% isn't just a number anymore, it's a glaring warning sign that we are becoming less efficient and losing serious ground to our biggest rival. A single number means absolutely nothing without these comparisons. And that leads us directly to this quote, which honestly should be framed in every financial analyst's office. Calculation is only the first step. The more important thing is interpretation. The single biggest mistake junior analysts make is doing the math, handing in the spreadsheet, and just stopping there. If you don't explain the why and what the actual business implications are, you haven't really done the analysis. You've just done math. So how do we guarantee we're interpreting and not just calculating? We use this straightforward 4-step workflow for analyzing any financial metric. Step 1, context. What is happening in the broader economy and our specific industry? Step 2, comparison. How does this compare to our past performance and our peers? Step 3, interpretation. What does this change actually mean for our daily operations? And Step 4, professional judgment. This is where wisdom comes in. It's synthesizing all this data to make a strategic decision about the future. You're moving methodically from raw data to seasoned executive action.
Which brings us to our final thought for today's explainer. It's a question I really want to leave you with. Your company made a profit today, but do you really know why? Was it brilliant boardroom strategy, or did you just get lucky with a temporary drop in raw material costs? Were assets used efficiently, or did you just take on a dangerous amount of debt? Don't ever accept the final number on the page at face value. Interrogate it, find the context, make the comparisons, and uncover the real story. Thank you so much for joining me, and I look forward to seeing you crack the code on your very next financial statement.